Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discuss is intended for information and educational purposes only and should not be considered investment advice or investment recommendation. If you invested $1,000 in Berkshire Hathaway in 1965, it would have grown to $36.4 million by 2023. In comparison, if you'd invested the same amount in the S&P 500, it would only be around $302,000. This significant contrast makes us wonder, how does Warren Buffett achieve such impressive success? At 93 years old, Warren Buffett still leads Berkshire Hathaway as CEO and chairman, at the time of making this video at least, a position he's held since 1965. He's widely recognized as the best investor in history. During his tenure, the value of the company's stock has consistently grown by 20.1% each year, nearly double the 10.5% yearly growth of the S&P 500, a major stock market index. Although this difference might only seem slightly significant initially, when you consider the power of long-term growth, it becomes substantial. Let's make an example and take a look at the Berkshire Hathaway itself. The company had an impressive stock growth over the past 20 years. The stock had grown by 560% since 2004. Buffett has grown the value of Berkshire's stock at a compounded annual gain of 28% in 20 years. Meanwhile, the S&P 500 grew by 360% in the 20-year span, with an 18% annual total return of the S&P 500 over the same period. Warren Buffett's success in investing boils down to his smart way of looking at things. He sees stocks as owning pieces of real companies and thinks it's crucial to think like you're running a business. What makes him really good is his focus on picking companies that have a strong edge over others, something he calls an economic moat. He likes to stick with these kinds of businesses for a long time. Buffett also knows the power of making money grow over time. He takes the money a company makes and the dividends it pays and reinvests them to buy into more businesses. This way he shows how patiently investing and letting your money grow can create a lot of wealth over the years. While Berkshire Hathaway, or ticker symbol BRK.B, itself doesn't give out dividends, more than half of the stocks in its $310 billion portfolio do. The best dividend stocks in Warren Buffett's collection bring in a lot of money for him. In 2022, Berkshire Hathaway got $6.04 billion from dividends, which is more than the $5.06 billion in 2021 and $4.89 billion in 2020. Dividend stocks can be great for investors because they bring in good overall returns, including both the increase in stock price and dividends, over a long time. Regular increases in dividends can make the profit on your original investment higher. If you stay invested for a while, the small profit that you got initially can turn into a much bigger one. Notable holdings and dividend income. Berkshire Hathaway strategically invests in companies that provide essential products for daily life. These holdings, carefully chosen by Warren Buffett, not only contribute to portfolio diversity, but also pay dividends. Chevron has consistently raised its dividend for 36 consecutive years, making it one of the top dividend stocks endorsed by Warren Buffett. It takes up 5.9% of the Berkshire Hathaway portfolio, and Berkshire Hathaway owns 5.7% of Chevron. Coca-Cola. Coca-Cola is one of the oldest investments in Berkshire Hathaway's portfolio and a top dividend stock favoured by Warren Buffett. Buffett began buying shares of the beverage giant in 1988 and amassed 23.4 million shares by the end of 1989, valued around $1.8 billion. As of now, Coca-Cola is the fourth largest holding in Berkshire's portfolio with a value of $22.3 billion. Over the years, the stock has shown a compound annual growth rate of about 8%, which is slightly below the overall market performance. But what makes Coca-Cola even more attractive for Buffett is its substantial dividend. The company pays an annualized dividend of $2.32 per share. Considering Berkshire's 400 million shares, this translates to an annual dividend of $920 million from Coca-Cola alone. In simple terms, the dividends received from Coca-Cola would cover the entire cost of Buffett's initial investment in the stock within approximately 2 years. This highlights the power of compounding in action, showing how dividends contribute significantly to the long-term success of an investment. The importance of quality businesses. Warren Buffett's transition from the Cigar But Strategy to a concentration on high-quality businesses for long-term investments signifies a pivotal change in his investment approach. The Cigar But Strategy, named after the idea of finding discarded, undervalued stocks with a single remaining profitable puff, was instrumental in Buffett's early career success. This tactic involved identifying temporarily mispriced stocks and aiming for quick profits. However, as Buffett evolved as an investor, he shifted his focus towards acquiring businesses with enduring quality, rather than relying on short-term, one-time opportunities. The Cigar But approach, while effective for Buffett during his formative years, comes with inherent risks and limitations that make it less suitable for many investors. One of the key drawbacks of the Cigar But strategy is its speculative nature. It involves picking stocks primarily based on their short-term mispricing, with less emphasis on the underlying fundamentals and long-term prospects of the business. This speculative approach can lead to a lack of sustainability and increased volatility in investment returns. Moreover, the Cigar But strategy may not align with the risk tolerance and time horizon of most investors. It requires a keen ability to time the market accurately and capitalize on fleeting opportunities, making it challenging for those who do not have the resources or expertise to consistently identify undervalued stocks. Buffett's shift towards high-quality businesses reflects a more reliable and long-term oriented investment philosophy. Investing in companies with enduring competitive advantages and strong fundamentals provides a more stable and predictable path to wealth accumulation. While the Cigar But strategy played a role in Buffett's early success, its speculative nature and reliance on short-term market inefficiencies make it a less ideal approach for the broader investment community. Buffett's thinking changed over the years, leading him to adopt a more long-lasting and sustainable investment strategy. He came to understand that real value comes from investing in businesses with strong advantages and solid foundations. This became a guiding principle for him, showing a shift towards prioritizing quality over quantity in the world of investments. See's Candies, a small and humble candy company, had a big impact on how Warren Buffett approached investing. It showed him the importance of putting money into businesses that have lasting strengths. See's Candies proved that things like having a strong brand, being able to charge higher prices for products, and having loyal customers can help businesses stay strong and successful for a long time. Watching See's Candies succeed taught Buffett that businesses with these lasting strengths can keep making money and stay tough over the years. This lesson made him change his focus. Instead of just trying to make quick profits from cheap stocks, he started looking for ownership in high-quality businesses. Buffett's way of thinking, which values lasting value and quality, has become a key part of how he chooses companies to invest in. Now he looks for businesses with strong advantages that can keep growing for the long haul. Berkshire's dividend reinvestment and wealth building. There is a reason why Berkshire Hathaway doesn't give out dividends. Rather than paying dividends, they keep the money they make and put it back into the business or use it to buy new companies. Buffett thinks this is smarter because it helps the company grow more over time. He opts not to pay dividends, preferring to reinvest profits for continued growth. His strategy reflects a belief in the company's ability to allocate capital effectively, seeking long-term value creation through wise investment choices. In other words, he thinks he can do a better job of making more money than the shareholders can with the money paid out to them, and the shareholders put their faith in Berkshire to do exactly that. Berkshire also avoid immediate taxes on the money this way. Berkshire believes in playing the long game, holding on to their earnings for flexibility to make big moves when good opportunities come up. This strategy has worked well for him and shareholders, as we can see from the historical evidence. Buffett's investment philosophy revolves around long-term ownership of businesses exhibiting enduring strength and consistent profitability, a principle that extends beyond immediate dividend considerations. His strategic investments in companies like Apple and Coca-Cola exemplify the nuanced nature of his approach. When Buffett invested in Apple, the tech giant initially did not pay dividends, but its unwavering performance and market dominance impressed him at the time anyway. Over time, as Apple matured as a company, it implemented shareholder-friendly practices such as stock buybacks and dividends, reinforcing Buffett's confidence in its adaptability and enduring market position. Now Apple takes up a very significant portion of his portfolio. In the case of Coca-Cola, a cornerstone of Buffett's investment portfolio for an extended period now, the company's regular dividend payouts align with his preference for businesses with a proven track record of generating consistent earnings and maintaining a strong industry presence. The dividends, in this context, not only serve as a source of income for investors, but also underscore the stability and financial health of the company. Buffett's focus on business ownership extends beyond the immediate allure of dividends. It encompasses a holistic evaluation of the company's fundamentals, including its competitive positioning, management quality, and potential for sustained growth. While dividends may not be the primary driver of his investment decisions, their emergence in the company's financial strategy often becomes a vital element, signaling not only shareholder value, but also the enduring financial robustness of the businesses that capture Buffett's confidence. In conclusion, Buffett likes to invest in businesses that have a strong and lasting value, and dividend stocks often match that by giving a stable and reliable source of returns. It's not a deliberate focus on dividends. Rather, dividends become a natural outcome of investing in fundamentally strong and enduring businesses. For Buffett, the key lies in identifying companies with intrinsic value, robust financials, and a proven track record, characteristics that often lead to sustained growth, and subsequently the distribution of dividends. The correlation between Buffett's investment criteria and dividend-paying companies underscores the convergence of stable returns and enduring business value in his strategic choices. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend-paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!